Cook with Nadex, and we've got Brian Caprice ready to go for the day. And what's a pretty confusing story across the board. It appears to be. We've heard tons of mixed messages this week. We're heading into the last couple days of U.S. trading for the week, and Brian, I'm kind of confused. Before we get into everything, I'm going to go ahead and quick risk disclosure before we get going because it is risky time in the market. As always, trading does involve risk. Only use risk capital, not grocery money, not mortgage or rent money, not car payment money. Only money you can afford to lose. Nobody goes into trading or thinking about the markets thinking they want to take losses, but it happens. It does every day. Take accountability for your trading decisions. We're going to be looking at some key levels, including some markets that are really rolling. Please understand this is for educational purposes only and not a recommendation to buy or sell any instrument. And with that, Brian, what is going on?
You said mortgage money. I don't think people are going to be using mortgage money anymore because at this point, who's getting into that market? So I just got to say, this is again, yesterday we talked about some major movement in the markets, but really no news justifying it. It was kind of like, do they know something that other people don't know? That could absolutely be said today. We're seeing continued yen strength. And again, the yen strength is coming in because of what we're seeing in the overall stock indices. There are people out there that thought the bottom was in. We've gotten our pullback. It went down to technical levels, and then yesterday happened, and we just got obliterated in the side of the stock market. And it's still continuing to drop. I mean, we were talking. I was just telling Dan a second ago that yesterday on the smaller time frames, we were talking about pullbacks and continuations, pulling the 23, and kind of what some of these targets look like. And I was like, wow, this look kind of bad over here, but we're all the way down here now. So I mean, we blew through these targets at 12,000, and God, we got all the way down to, in the overnight, down to 11,700. So yeah, the bleeding is occurring, and it's crazy. In the currency market, you would say, well, what's going on? Was there news? What did I miss? Is the dollar getting, is it going crazy again? And the answer is no. Euro dollar 13 pips in 24 hours. Pound dollar 8 pips in 24 hours. Dollar CAD minus 2 pips in 24 hours. Aussie dollar minus 7. Euro pound. Is there a lot of movement in the European currency? 4 pips. But then we look at the euro, the dollar yen. Remember, the yen's weak, right? Down 170 pips. It's back down to 127. So we were flirting with that 130. It was like, oh God, the island's sinking. But now it's 300 pips lower than what they're like. This is good for us, right? At this point, they may look at the other side and say, hey, maybe we need to do something to make this weaker because it hurts. And then the pound yen down 199. But that's not even the biggest story this morning. The dollar Swiss. And again, we were talking about, listen, they got a bad situation. It's down 238. It's between 4 and 5 times its daily ATR. Typically, the ATR is about 65-ish. Right now, obviously, because of the last 2 days, it's higher than that. It's up into the 80s or 90s. But it's still, if you did that, it's still 3 times. But the average is about 65. We're like 4 times, just over 4 times the daily ATR in 24 hours. If you look at the headlines, there is 0 headlines. And it's not like it's the dollar causing this. This is purely Swiss strength. Now, I talked about this and mentioned it yesterday. And again, I still can't figure out why Jordan said this. I haven't been able to find the actual headline. But again, if inflation strengthens, we're ready to go. We're not going to be held hostage by again, very pointed statements. I don't know who is holding them hostage or what it is. But again, this is still from yesterday morning. And the other story here is, we see inflation as the largest global spectrum. The Swiss franc is a safe haven. That's an interesting statement, but again, made yesterday morning. It's continuing to roll. Negative interest rates and currency interventions are necessary for the S&P to meet this mandate, and we're ready to intervene in the currency markets when necessary. Now, again, Japan is also big into that. These comments were from yesterday, and it's just continuing to roll. And it's not like it's been steady either. Looking at the dollar Swiss, where did a lot of this come in at? Yes, we had a big push down yesterday, and then it slowed down. And then this morning at 3 o'clock, when the European market opened, again, we use this period, this little arrow right here. That is our 3 o'clock candle right there. Again, just off to the races. So those comments were yesterday. So I don't know what the S&P is doing over there, but again, it was, the Swiss was really getting beaten up because they did put sanctions on Russia. I don't know if they're starting to remove those Russians, but it's interesting talking about it being a safe haven because it's not considered a safe haven anymore on a global spectrum. The world doesn't consider it safe. They put sanctions on another country. So in time of war, it used to be every Swiss got a ton of strength. Maybe now that strength is coming back into the market because they said, hey, you know what? And this could be it. Maybe what Jordan means here is that they felt that they were bullied, that they had to put sanctions on there, and saw their currency going really against them, and they said, "Listen, we're not going to be held. We're not going to be held sanctions. What we want to do is what we want to do," and that's why we're seeing again being that safe haven. It's weird that they use safe haven because that's always the term associated with any type of war or geopolitical event. The Swiss is a safe haven. Send the money to the Swiss because they always neutral in every conflict. They did sanction Russia. They agreed with the sanctions that took them out of that role. And now they use the terminology. And what are we seeing? We're seeing the dollar Swiss really just, really in the last, 2 days, 3 days, when we broke through parity, it was like, yep, this is where this is where we deserve to be. And then 350 pips in 2-3 days. That's enormous movement. So, yeah, who knows where that would stop it. Yeah, it's crazy. Another thing that I think is very, very important to note, again, a lot of this is not dollar-based right now. Typically when you see this, you're looking at the dollar and you're like, all right, what's happening over here? The dollar is down a little bit, but it's not, it's down 0.7%. It's still kind of in the same range. It had a really, really strong push up. And again, the comments, basically Powell's comments, the market's like, we don't believe anything you just said. And we saw some more weakness, but it's not the dollar right now that is leading the drive. The dollar is actually getting drugged behind the indices right now. All the indices are we just got data. The VIX is up a little bit. All the indices are in the red. The data that we just got was that the Philly Fed manufacturing index was low. It was expected to be 14. It came in at 2.6. It was not as bad as Empire being minus 11. We talked about how horrible that was. And we do actually know why this is happening. Unemployment claims were also higher than expected. So these are kind of negative things over here. Remember, what they're saying is the biggest problem is, yes, inflation. We know it's inflation. But it's the fact that it's demand, right? That there are 11 million jobs open, but only 5 million people willing to work. That's what's driving things. We heard from Target yesterday, and Walmart. We talked yesterday about the Waltons lost $27 billion or whatever it was. Basically saying that we have way too much supply. We have way too much inventory, which means, and again, hold on, the statement was, let's see it's here. We have larger items because people weren't buying those items. Things like kitchen appliances, TVs, and pieces of outdoor furniture, back rooms, and warehouses that could otherwise carry food or personal care items are getting crowded out. The choice: hold on to those bulky items or sell them at a discounted rate. We chose the latter, leading to incremental markdowns that reduced our gross margin. Again, very difficult decision. Target said they're going to take a couple quarters to work through and sell through these excess inventory. And then everybody else basically slammed Dollar Tree, Dollar General, Dick's Sporting Goods, Costco for the same measure. So it's a weird scenario. We have inflation at 40-year highs. We're seeing manufacturing starting to grind to a halt, which is one of those things that leads us into a recession. We're talking about big stores. The big boxes out there are lowering things to get rid of inventory because they can't store other things that we actually need. Those are the items that have the highest amount of inflation associated with them, but they're seeing lower margins. Then we just got this from Fed George just a little while ago, right? The stock market provides an important price signal. Yes, we mentioned that yesterday, that the market is always right. It's interesting when the Fed talks about it. This is she hit now this one on. Fed policy is not aimed at the stock market, but effects of policy will be felt there. And she's 100% correct. They don't care about the stock market at all. Their job is the economy, and the economy is not the stock market, although the average trader believes that they are one and the same. This is why it was a couple years ago, Trump was always looking at the stock market as a gauge of how well he was doing, because that's what people feel like. They don't have an actual true gauge of what the economy is. They look at the stock market as that gauge. My question is she telegraphing what's about to come? In determining when enough is enough in policy tightening, the chief focus is on inflation numbers, not what's happening in the stock market. Inflation is too high, and the Fed needs to bring that down. Okay, so again, the Fed will succeed in bringing down inflation. It's hard to know how much tightening will need to happen to make that happen. Remember yesterday we talked about this? Akash Kari said, hey, listen, the Fed may have to induce a recession. Right now, what is it going to, they said we have to lower that JOLTS number. What is it going to take to get those companies to stop looking for new employees? Now we have too much inventory, too many jobs. Manufacturing is grinding to a halt. Interest rates are rising, and we know Powell said the next two meetings we're going to raise 0.5, so we're going to be at 2%. I joked about the mortgages. We're already at over 5%. Is that going to hit 6? Is it going to hit 6.5? I don't know. Every sign here is like recession, and look at the indices dropping back down. We were all the way back over here. This is ES on the 30. Look at this. This is quite a fall that we have here, and continuing the drop, and they're all in the red right now. So, yeah, I would say right now, again, yesterday we talked about, extensions, and again, just nothing was positive out there. We saw nothing but negativity. This is none of this information is great as well. We got existing home sales coming in. The one reprieve we are getting right now, and again, it makes complete sense why. Oil now is down to 103.50 again. Okay. There was a number, there was actually, and this is kind of the craziest part about it. If you look to see what happened yesterday with the oil inventory report, the oil inventory report actually was down. We had actually a reduction in supply. You would say, well, wait a second. That means oil's going up. We're running out of oil. We don't have enough. There's demand here, right? China is actually reopening as well. But what are we seeing? CL is down to 103 now. We were at 115 2 days ago. How the heck did we get to 103? This is basically the sign right now that, listen, commodities are starting to crash. Why? We're going back into a recession. People can't afford things. Hey, we got oil here. It's not like suddenly magically there's a whole lot of extra supply in the world. And again, maybe this is also the Swiss saying we will take Russian oil because we can't go without it. So this is a huge drop in oil in 1 week, a very, very big turn. Natural gas is actually also red as well. We got a big push. We didn't quite make it to our profit target yesterday. We got to about a 1 to 2.8, almost that 1 to 3 before it kind of came back again. We're kind of where we were. Yesterday, we were actually sitting right around here, so we're not too far from it, but it did at least get a pullback. It didn't go all the way up and tagged at $8.09. And again, another sign right now that, hey, listen, this may be coming down. How do I know? Gold. Gold is actually up 1.3%. Again, we chopped back and forth, probably got stopped out at break even. We didn't hit the 1800 this week. Remove these drawings and we can say, hey, listen, we got a 50% retracement up at here at 1850, but really no tested levels until we get much, much higher up. How the heck is gold up 1.29% and silver up 1.7%? The stock market is crashing. People need to figure out where to put their money. Right now, with everything that Powell said, the market was like, nope, everything you just said, I just don't believe. And people are starting to play the inflation game again, particularly because, again, talking about the big boxes having too much supply, having to cut discounts on things. These are all things that are leading back to inflation again. So it's odd. You're seeing flight to safety. And again, remember, gold is always kind of a flight to safety in itself. It's an asset that always exists. Again, cryptos are up a little bit as well. People are looking for a place to put their money because they're taking it out of the stock market and they're looking for some place to put it. And again, gold is up, a decent amount. Bitcoin's up a little bit. And bonds, look at this. Bonds is gapping up 2%. We've been talking about the decline in bonds forever. And where we're at right now, we just literally got past the 50. We're coming up to the 61.8 right now. How the heck are bonds rallying right now and an interest rate rising? It's a flight to safety. People are worried about this recession and looking at Target, Walmart, Dollar Tree, Dick's Sporting Goods, looking at all these big box retailers saying, hey, listen, this is bad when our earnings come out. This is kind of like worst case scenario. Crazy inflation, rising interest rates, and we got way too much supply. So I don't know. I've said this for 2 years. First, it was the transitory. Then it was the supply chain issues. Every excuse we get is turning out to not necessarily be true in the long run. And again, scary that one day a Fed person says, "Hey, listen, we could, we may have to drive into a recession to kind of kill demand." And the next day, we have somebody else saying, "Hey, listen, the stock market is not our problem, not our issue. We have to focus on inflation, and that's what we're looking at because again, that's what their mandate is." So who knows what's coming down the pipe here. So
I think they're kind of saying strap in.
I think so.
And I really feel like we'll look back even 5-10 years from now, kind of similar to how we look back on the 2000 tech bubble burst, 2008, 2009 housing growth, and this is absolutely a study in market dynamics and what the heck is going on.
Yeah, because we've never really had this scenario before. We talked, I guess it was last summer, we were talking about stagflation. Everyone was like, what the heck is that? That'll never exist. That's not something from the past. We never saw it before. Yeah. We've never been in basically a zero interest rate environment. Again, the Fed admitted that they waited too long. I mean, Powell said it. Yeah, we waited too long. We should have been more aggressive with this. But at the end of the day, they didn't want to be the cause of a recession. Now, Jamie Dimon says the Fed's going to have their hand forced. Well, it looks like Jamie Dimon was correct again. They're getting their hand forced. And now the fact that they may have to drive us into a recession, especially going into a voting year. Yeah, it's a very weird scenario out there in the market. So again, how do you play this today? I would say be very, very cautious. Again, I think the indices would be the way to do it. Look for some of these traps. I mean, the way that they've all pulled back, again, particularly on the 15-minute. We've mentioned this trap in the last couple of days. There's obviously a Globex low right there. We've kind of pulled back, and you can actually kind of give yourself, not necessarily Globex high. Yeah, I guess you can. It's like midnight. 2 o'clock is. I mean, the 3 o'clock area is right here. You can kind of set yourself up for a bit of kind of a trap maker for less than a bit, less than a better word. A lot of times, again, like as I said, it breaks through. People are like, "That's it, we got to go short," and we've seen it pull back again and again and again. Right now, at least in the overnight, look in the last 24 hours, you can see the price has bounced right off the 50. It's kind of doing the other direction right now, but I would say look for the negativity. The numbers that are out there on a fundamental basis are not really good overall for the market, and everybody's still talking about Target and Walmart. So for me, overall, I would say I am a bit more bearish today than I am bullish on this one. If we wanted to kind of remove this, and again, the short-term overnight traders are definitely short. This is what we're kind of looking for. If we get a bit of a rally higher, there is a 23.6 selling level. There's a little, I would say there's a little bit of selling right there. You can see that there's a level of basing right here and then a kind of big push away. So that number comes in at, what are we at? 39.14. I'm going to make this lighter. I changed that yesterday and now it's there. 39.14 if we can rally up to there maybe. And at this point, they may even set the Globex trap at a little bit more near turn and put it right here, where, again, if it pokes through, people are like, that's it, it's going long, because that was 7 o'clock in the morning. It may be an instant reversal, but none of the data looks great. We have home sales today. Everything is in the red. The VIX should settle down since we have some news. But I would say, any other day you would say, oh, my God, oil's back down to 103. It's cheap. This is good. It's going to help us not have the price pressure. But, and again, Walmart, they're going to start selling big items for a discount. This is all great. But right now, with factories turning off, maybe that's where the jobs are coming from. They're going to start, canceling some factory jobs. And again, God forbid we start laying people off, that would be the next kind of log onto the fire for recession. So
100%. And I think that's amazing. We don't want to, we don't want to be the cause of a recession too. You know what? We're going to drive you directly into a recession.
Like I said, I've never seen anybody say this, that we may have to induce a recession. Sorry, guys, we may just have to do it. And then again, followed up by another one of the Fed, name. God forbid Bullard says, yeah, we need a recession. Like any of the big ones, or Bernard, like if I was her, I'd be like, I don't know what's going on. I wasn't there. I was on vacation. Her role is taking over next time is not going to look good if, she was put in and said that she is going to be the replacement for Powell, that she will offer continuation, and they're grooming her, and then Powell sends us into a recession inside of an election year. So, yeah, weird.
Oh, yeah. Awesome, Brian. I appreciate it. What a day. What a week, and likely to be a month, a summer, and on and on. With that, clearly, I think, and we'll be back tomorrow with more good news on the financial front, but always remember, particularly in times, and in every time, but particularly in times like these, manage your risk. This could only be risk capital. I'll also remind everyone that cash is a position. So you don't have to be trading every minute of every day. My boss might kill me for saying that because we love volume, but the reality is you do not have to be pulling the trigger at every moment. Sometimes good to take a step, take a pause, always manage your risk. Brian picked out some key levels. This is for educational purposes only, not an indication or, us telling you to buy or sell any financial instrument. With that, Brian, I appreciate it and appreciate all of you joining us. And we'll catch you tomorrow as we wrap up the week. Great day, Brian.
Yep.